Hello and welcome to FinextraTV's Thought Leadership Series. I'm Hannah Wallace, and kindly joining us on the call today is Andy Wills, Director of Data Insights, and Mohammed Chaudhri, Chief Economist for Experian. Hello gentlemen, thank you very much for joining us today.
Hello, hi.
Now today we're talking about the changing economy and looking at the transition from pandemic shock to economic shock, how this compares to previous crises and what the future might look like in this space. But to kick things off, I'd really like to home in on credit markets. Andy, coming to you first, how have you seen the credit markets change since the COVID-19 pandemic?
Yeah, there are three things I'd like to kind of call out, and then I'll go into them in a bit more detail, if that's okay. So first of all, there has been a significant contraction in new lending, really very significant, and there's been supply and demand factors there. The second is that we've seen income shock coming through, so people on furlough and even some people losing their jobs, impacting income and impacting their affordability for credit products. And finally, we've seen the effect of emergency payment freezes. So effectively emergency payment holidays on something in the region of 4 million credit accounts, which is suppressing the view of those credit accounts for arrears. If I talk about the first in a little bit more detail, so contraction of new lending. So from around about the second week of March, we saw a very significant reduction in new lending, and there was both a demand and supply effect there. So on the demand side, we absolutely saw borrowers being reluctant to borrow, and that was in part affected by lockdown. They couldn't get to the shops, they couldn't spend, and so not willing to borrow. But on the supply side, we also saw very significant changes in mortgages, in auto finance, in credit cards, in personal loans, where lenders were taking credit products off their lending panels and not making them available for lending. So we see both factors, and we saw something in the region of an 80% reduction in new lending in the first week and a half of lockdown. It's begun to come back, but rather slowly, as you'd expect. On income shock, it's still relatively early days. We are seeing a reduction, something in the region of 40% of the accounts we monitor. We're seeing some level of reduction in income, which understandably affects individuals' affordability for new credit products, but we expect that position will worsen as we move through the summer and into the autumn period.
Well, we'll go into that a bit more later on, but for now, Mo, is there anything you would like to add to that?
Just to take that point further about the near-on collapse in new lending, the statistic that stands out most for me from an economics perspective is the fact that we saw this almost forced deleveraging. And by that, I mean that we saw repayments outstrip demand for 2 consecutive months and to levels that we've not seen before. So in order to try and understand the impact of COVID-19 on the credit markets, it really is about trying to unpick whether these are forced and repayments almost, as Andy has already pointed out, with the customers no longer having the ability to go out and spend, or if these are precautionary, looking forward to potentially the economic shock, which is around the corner.
Mm-hmm. Well, as I mentioned before, we have transitioned from pandemic shock to economic shock. So, Mo, coming back to you then, what are the critical factors of the economy that firms should be looking at the moment?
Absolutely. And this is a question that we've been asked again and again by our clients. No two crises are the same, and I'm sure we'll touch upon that later on in the interview. But for this crisis in particular, the ability to actually understand which sectors are most at risk from the pandemic is key. Now, just looking around the economy and recent announcements from employers, we can see once again that the accommodation and food services, the aviation industry have come to the fore with announced job losses. Now, from a credit risk perspective, that really does have an impact. It's because once you try to understand your exposure, your consumer's exposure, your borrower's exposure to those industries, only then can you try and actually get a real hold of the impact that the pandemic, the COVID-19 effect is going to have when we move from pandemic to economic shock. So some of the key indicators that we're looking at are obviously unemployment. And we've spent a long time trying to unpick what the real unemployment rate is. As Andy's already mentioned, the emergency payment holidays are masking somewhat the real credit behavior that would be seen through the Bureau at the moment. It's in the same realm that the furlough scheme is potentially holding down what the true level of unemployment is. And here at Experian, using our wide array of granular data, we are now starting to unpick and get to what we are calling tailored unemployment curves. So lender by lender, we can start to see the exposure that the impact of the transition from pandemic to economic shock is really going to have.
All right, well, with furloughs ending alongside evidence for public health, what would you say we can expect from the summer ahead then, Andy?
Yeah, so the picture, I think, is going to be challenging, tough, words of that ilk. I think we unfortunately will see a growing wave of corporate failures, but also we will see for the strong corporates, likely we will see actions being taken to resize their businesses. Both of those factors will have an impact on employment, and inevitably in turn that will have an impact on the credit market. That will lead to a position on arrears. The severity of that is difficult to determine with clarity. We believe that the moves over the next 6 months will move very, very quickly, and we would expect a position on arrears, for instance, in credit, to be significantly higher than the peak of the 2008-2009 credit crisis. So I'm afraid the next few months and rolling into next year are going to be pretty tough times economically and from a credit perspective for the UK. We will see lenders wanting to extend lending to good customers, and that is already a trend in our discussions with our major clients today, and they will be looking for opportunities. So people who have been on furlough but perhaps have resumed work, and perhaps when you look at the underlying affordability of those individuals, they are good bets from a credit perspective. But there's going to be a lot of bad news wrapping around that, I'm afraid.
Mm-hmm. But of course, this isn't the first economic crisis we've seen, is it? Mo, can you tell us how you see this crisis compared to the previous crisis and whether the two can be compared at all?
Yeah, to borrow another very popular idiom at the moment in terms of no two crises are the same, that holds true. But there are things that we can learn from the previous crises. And one of the things that we are paying close attention to is how we can actually try and track through whether a credit crunch is actually emerging or not. Now, one of the key lessons from the last crisis was I myself was at the Treasury at the time of the last crisis, working in central government, trying to understand what policy measures could be taken to try and return the economy to growth. Now, a credit crunch has a long tail in terms of recovery. Any crises associated with credit crunches really do take a long while before we return to any kind of normal growth. And that's where this crisis is starting to borrow from that literature. We ourselves in Experian have termed the recovery as a delayed V-shape within the economics team. We expect a strong bounce back initially, simply from a almost arithmetic perspective. When the economy exits lockdown, those firms weren't producing only a few months ago. Now they're producing. You're going to see a sharp bounce back within the official statistics. However, again, everything that we've spoken about before, the long summer ahead, the wind down of the furlough scheme, the wind down of the emergency payment holidays are really going to put a constraint on how quickly the economy can grow going forward. And therefore, this shape of a delayed V-shape, which we have termed, is one of the scenarios which we still think are going to be most relevant.
Well, Andy, I can see you listening and nodding there. Anything you'd like to add?
We expect the pace of change to be even faster than the credit crisis. The lead into 2008 really began around about 2005-06. And so the worsening of the credit market took 2 or 3 years really to reach that tipping point. This is weeks. This is happening in weeks. It's that fast. The most optimistic outcome is it's sharp in and sharp out of recession. Time will tell.
Yes, it's going to be very interesting seeing how this space develops. And now I'd really like to end on hearing a bit more about what Experian are doing in this space. What have you been focusing on during the pandemic?
Yeah, so we've always had an innovation agenda. We're always looking at ways that we can do new things with either new data or technology to enable our clients to understand the credit market and affordability better. In particular, over the course of the last 3 months, we've been working on some very actionable insights. We've created a service called Bureau Triggers, which looks at changes to individuals' affordability, so looking at income shock metrics. And again, we've got this fantastic set of data, starting with the economics data that Mo looks after, leading through into credit and affordability data, that enables us essentially to model the whole of the UK population from an income perspective with a high degree of precision. We're also working very, very closely with lenders on understanding the effect of the payment holidays, which the whole lending industry is understandably concerned about. Where we've developed insight into that, so we've modelled our own payment holiday indicator to be used in conjunction with other data and services, but certainly something that is over and above the position that is available more generally. On payment holidays, the FCA absolutely have acted with positive intent very quickly to protect consumers, but the effect of not reporting a payment holiday flag has left lenders blind. And so we're trying to fill that gap and provide some degree of insight on that front.
And Mo, anything you'd like to finish on?
Very much so. Experian and innovation, terms that go hand in hand. And within the economics team, we've really had to speed up the way that we're thinking about how we can help clients understand, like I mentioned, those local and regional impacts of COVID-19 more than any other crisis. Because of the sectoral biases, there are certain areas in the country where we have car manufacturing plants, where we would have those big aviation hubs in the south of England and in the Midlands as well. And so actually being able to provide our forecast scenario capabilities down to that very granular and regional and local level, it's the way that the clients and our clients that we serve, the lenders and the FS institutions, can actually take those actionable insights that Andy mentioned.
Well, as you say, we're entering unprecedented times, so I urge people to keep an eye on the work you're doing at Experian. But for now, gentlemen, thank you so much for joining us today. It's been really informative. Thank you.
Thank you.